Okay, hello everybody. It's Larry Berman here. It's 1 o'clock Eastern Time on Tuesday, December 11th, and welcome to the Investor's Guide to Thriving webinar version. So for those of you who couldn't make it out to one of our live events, hopefully the next hour and a half will be all encompassing and try to capture everything we did in the live events for you. There should be about 10 or 15 minutes of Q&A at the end. So for those of you who want to ask questions, you can put them in the queue there, and we'll get to them at the end of the talk. The starting point of the presentation will be about a 10 or 15 minute presentation, hopefully 10, by BMO, just an introduction to BMO and BMO ETFs and some of the great things that BMO has in terms of the educational side. So as with all these things, we want to talk about our charity efforts, and on to this week's show, I talked about the fundraising this year. We did about $25,000, and in the 9-year history of us doing the road shows across Canada, we've raised now $400,000 for the Baycrest Hospital here in Toronto. That's one of the world leaders in brain science and health research, and cancer at Sick Kids Hospital. Those are our two chosen charities. So you will get, at the end of this webinar, you'll get an email for feedback, and they'll have links there. Encourage you to make a donation, and I will personally match all the donations that come in to these charities. So thank you for that, and thank you to our sponsors, specifically BMO Exchange Traded Funds, and some of the other firms that are involved with my business and with our educational efforts across Canada. So right now I'm going to introduce you to Dan Stanley. He's with BMO ETFs. I'll set the bar pretty high for you, Dan, here. He's one of the top ETF experts in the country. So you're really hearing from one of the best here. And right now I've turned it over to Dan, and Dan, go ahead.
Excellent. Thank you. And thank you all for joining us. So as Larry said, my name is Daniel Stanley. I'm an ETF specialist at BMO Exchange Traded Funds. And what we're going to talk about for the next 10 minutes or so is just simple rules to make you a better ETF investor. But before we do that, what I want to do is I want to tell you a little bit about the BMO Exchange Traded Fund story. And I'm just going to scroll over to the next slide. There we go. We have a fantastic story to tell. You know, when I joined BMO ETFs back in 2012, BMO had roughly about $8 to $9 billion in ETF assets under management. And as of this week, we are just about to hit the $50 billion in assets under management mark. So business has been going very, very well. We are the fastest growing ETF company in Canada. We're the second largest ETF company in Canada. You know, we have the largest suite of bond ETFs. We have the largest suite of smart beta or rules-based ETFs. And we've also got ETFs that are listed in the UK and in Hong Kong. So we're a global ETF provider. But one of the things that I want to drive home is that I'd be remiss if I did not acknowledge that BMO has been a big beneficiary of growth in the ETF industry. And you're seeing on the bottom of this chart here of slide number 5, the Canadian ETF market. You know, back in 2009, it was basically, or there were $30 billion in ETF assets under management in Canada. Right now, we're sitting at closer to $160 billion. But what's interesting is even at $160 billion, we are still only 10% the size of the mutual fund assets under management in Canada, the US, and globally. So there's tremendous room for growth. Now, what generally happens with growth is you tend to have the potential for confusion comes up. And that's why one of the things that we've done is, and I'm going to go over to the next slide here, is we've created a couple of resources, both on our website and our dashboards. Bear with me, the screen seems to be locked in here. There we go. So we've created some resources, and I will reiterate, these are free resources. There are no passwords to access these. So the first and foremost on the left-hand side is our dashboard. There are information on there. There's trade ideas. There's trade flows. There's information on ETFs and taxation that is very helpful, especially as we're coming up to the new year and tax season. And then the other resource I would highly recommend you take a look at is our website, www.bmoetfs.com. There are 3 key tools on there that are fantastic. There's a comparison tool that allows you to compare pretty much any ETFs in Canada. There's a screening tool on there, as well as a portfolio builder tool that allows you to build portfolios of exchange-traded funds as well as portfolios of mutual funds. So fantastic resources just to help you move along. And on to the next slide here. So what I want to do is talk briefly about some of the benefits of ETFs, and undoubtedly the first benefit is the liquidity of an ETF. So liquidity is basically the ability to get in and out of a security quickly and efficiently at a low cost. And ETFs do exactly that. And I often use the example of bonds. Individual bonds were not designed for investors like you and I because you have to trade them over the counter. You need a lot of money to build a portfolio. You need an account at a bond dealer. ETFs changed all that because now you can buy bonds or a basket of bonds in an ETF, and that ETF can be traded on a stock exchange, making it liquid. The second key benefit of ETFs, of course, is diversification. ETFs are baskets of securities, just like mutual funds. The key difference being, of course, that an ETF tracks an index. A mutual fund is trying to beat an index, but at the end of the day, they are baskets of securities, and you get the diversification benefits, which means that the risk of any one of those positions blowing up on you is diversified away by owning a large basket of securities. The third benefit there is the efficiency of exchange-traded funds. I often tell investors that I could build you a globally diversified portfolio of stocks, of bonds with just 5 positions. ZCN for the TSX, ZSP for the S&P 500, ZDM for MSCI EFI, Bonds Canada, ZAG, and international bonds with something like ZMSB. That's 5 ETFs. You get the whole wide world. Very efficient access to the markets. Cost efficiency, the average fee of a BMO ETF is probably about 0.35%. That compares to mutual funds, which are closer to 1.5%. Those savings go a long way to improving returns or improving your vacations, depending on what aspect you want to take. The last benefit there is portfolio transparency. This is a key benefit with mutual funds because they're active solutions. You only ever know every quarter what the underlying portfolio manager is actually holding. With ETFs, you can go to our website. You can look at the underlying holdings, what any of the individual stocks and bonds are in any ETF on a daily basis. The end result is that you can build better diversified portfolios while ensuring that there's no overlap in positions. All right, next slide. So from the benefits of ETFs, let's talk a little bit about the market of ETFs. And this is a great sort of chart that really describes the infrastructure of how ETFs work. There's a lot in here, but I just want to focus on the concept that the vast majority of ETF trades actually happen between buyers and sellers on the left-hand side of this chart who are trading ETFs on the stock exchange, that gray bar. So in Canada, for example, if you are buying or selling our S&P 500 ETF, if you're buying or selling $10,000 worth, chances are nobody's going to be touching the underlying securities themselves. You are going to be selling to someone who's going to buy that ETF, and there's going to be a buyer for the seller of that ETF. That, ladies and gentlemen, is what we call the first level of liquidity. The second level of liquidity on this chart is the right-hand side, and that's where you get into the larger institutional investors who are making very, very large trades in very liquid ETFs. And it's those transactions where you can clearly see that market makers, or I like to call them, these are the individuals that are the oil that makes the ETF business run. They're constantly providing bids and offers for ETFs, and they're basically buying the underlying securities for large ETF purchases. And if there's a large ETF redemption, they're going to come into the market and they're going to buy that and they're going to sell the underlying securities. At the end of the day, the market maker, the key point is they are the oil that makes the ETF business run. That is the second level of liquidity in the ETF industry, and that is the level of liquidity that ensures that ETFs will always trade around their net asset value. It's important to understand that an ETF does not affect the price of a stock or a bond. It reflects the price of a stock or a bond. All right, next slide. So the cost and efficiency, it's a couple of key rules of thumb here when you're buying and selling ETFs. Number one, know what you're buying. Know the index and the methodology. There's a huge number of methodologies out there, including market cap weighted, equally weighted. And now with all these rules-based ETFs, you could buy a low vol, you could buy a value. It's important to know what you're getting access to, so that you know what kind of stocks you're going to end up with in the underlying portfolio. So you always want to look under the hood of these ETFs, as we say on chart number 9 here. Another key thing to look out for, watch for the yields. You want to make sure that whatever the yield that ETF is paying out, make sure that the yield is being earned in the underlying ETF itself. If not, you're going to get return of capital. So we're happy to talk a little bit about that later on, go into more details. The other bullet points there at the bottom, know the costs. The media has really pushed the idea that ETFs are low costs. And while that's true for the vast majority of ETFs, a number of the newer ETFs that are coming out in the market, as you can see from that chart on the bottom right-hand side, there are a number of ETFs where management fees are in the 0.6 to 0.8 range. Whereas we've got some ETFs that are as inexpensive as 0.05%. So once you start getting into the 0.6 to 0.8 range, that would be considered a very expensive ETF. And there's a lot of newer ETFs that are very high on that expense scale. The other thing to keep in mind is taxation. Understand how a structure of an ETF can affect the tax situation. For example, there are a number of ETFs that may wrap other ETFs. And if an ETF does that, and you hold that ETF in a taxable account, oftentimes you are going to lose out on the withholding taxes. So it's important to understand, does the ETF own the underlying stocks, or do they own another ETF that then owns the underlying stocks? The last bullet point on there is watch the bid and offer spread. That is, in effect, the cost of the ETF or the liquidity of the ETF. My rule of thumb is 2 cents good. Anywhere 3 to 4 cents to 5 cents is not good. All right, so we're going to move on to the next slide, slide number 10. And here, apologies, a little slow. There we go. Sorry about that. Portfolio transparency. All we're sort of saying on this slide is the idea that when you buy ETFs, you know what you own in the underlying. So you can see on the top right-hand side there, that is the list of the holdings for ZQQ, which is our triple Qs in effect. It's the NASDAQ 100 ETF. And you can clearly see that you have a breakdown of every single one of the stocks that you own when you own ZQQ. So that's an important knowing what you're actually owning when you buy these products is critical. So this chart here, I call it the Rubik's Cube chart, where we've titled it Asset Allocation is Key. This is one of these ones where a picture's worth 1,000 words. So what have I put up here? So each column within this chart represents a year. Each colored square within each of those columns represents a different asset class. And the best performing asset classes are at the top of the chart. The worst performing asset classes are at the bottom of the chart. The reason why I've put this chart up there is oftentimes there's the impression that investing in ETFs and managing your money is easy to do. At the end of the day, it's very difficult to do. Reason number one is take a look, for example, at 2008, the top right-hand side of that chart. You can see that global bonds in that year, not surprisingly, were the best performing asset class. But take a look at 2009. Global bonds go down to the bottom performing asset class. The flip side of that argument is look at the bottom of 2008, and you'll see that emerging markets were down a whopping 41% in 2008. In 2009, they returned 52%. Now, I often ask people, how many people would have the guts to buy emerging markets in 2008 when the markets were dropping like they were? Not many people would have had the guts to make that decision, which ultimately, as you can see, was the right decision. So investing is difficult. The other option that you could do is you could rather than tactically move from one square to the other based on your knowledge and your experience, is you could all just buy all of these asset classes. And the gray box that's in the middle, the balanced portfolio that you see there, that is in effect what that is reflecting. The balanced portfolio is if you owned, sort of roughly speaking, 60% equities and 40% bonds. So there's two ways to invest: tactically, moving around these different asset classes into the areas you think will perform and out of the areas you think you won't, or you could do it from a balanced perspective. Now, moving on to the next slide, if you're one of these people who believes that you will not, you don't have the resources, the knowledge, or the time to tactically invest and move around from one asset class to the other, and I would recommend the vast majority of people do this, it's important to understand that Larry can do that for you. We couldn't be happier at BMO ETFs about our partnership with Larry. So Larry is really, really unique in the Canadian investment management industry because he's an early adapter of using exchange-traded funds to tactically allocate ETFs, which is in effect a style that is typically limited to only the biggest institutional investors in the world. But now, thanks to the partnership of both Larry and BMO exchange-traded funds, you can access Larry's strategies via these mutual funds, and soon, shortly even, an exchange-traded fund as well. Key thing to remember with Larry and his focus on these funds is on risk, specifically how much risk he's taking to generate each unit of return. And that's why the tactical dividend fund that I've put up on this screen here, that's why we call this tactical dividend fund the Sleep at Night portfolio. Just to give you some context, in managing this fund, Larry is always, I say he's driving with one foot on the brake. He's increasing the beta, or the sensitivity of the market, when he's bullish, and when he's bearish, he's decreasing his beta, or his sensitivity to the market. Key point here, we love it when Larry uses BMO ETFs, but he has the ability to use any listed exchange-traded fund that is out there to achieve his goals. Further, I would say the use of ETFs allows him to tactically change his views from bearish to bullish and vice versa almost instantaneously. Another key point is that the management fees on these funds are some of the lowest in the Canadian universe. They do include the costs of all the underlying exchange-traded funds. And I would say if you're interested in these funds, be sure to ask for the D series. That stands for the discount series, which you would purchase through your discount brokerage account. Without going into too much detail, this last slide just has some data on the longest running fund that Larry manages for us. It's the Tactical Dividend ETF Fund. It's a 5-star Morningstar fund, which means it's one of the best performing. It's won Fund Data Awards, Lipper Awards for best performance. And I will say it's done extremely well over a difficult environment over the last month. So I'd like to thank you all very much for your attention. And without further ado, I'm going to hand things back to Larry.
Okay, thanks very much, Dan. Now, moving right ahead, there's the disclaimer. Everyone read it, don't blink. Okay. Now we'll get into my talk. I'm really going to focus and try to move through towards the end because that's where the real meat is, talking about different strategies we can employ using ETFs and ETF options, to talk about some of the sectors I like, and ultimately what I call the sleep at night portfolio, but can also be called the all-weather type portfolio, where we focus a lot on risk management. So right off the top, I've been cautious for a couple of years now, and when is the bear of Bay Street going to ultimately be right? Question is, nobody knows when the bear market's going to come. David Rosenberg was on my show last week and talked about us being 1 foot into it. I'm going to do my year ahead outlook on next Monday's show, and I think the bear has already started. I don't think we see new highs, and ultimately the bottom doesn't come till sometime in 2020. Again, that's a guesstimate. As I always tell people, stay tuned Mondays at 11 in case I change my mind. But how bad is the next recession going to be? And that was the question that was asked about a month ago in the Economist magazine. And there's been a lot of debate about the yield curve and what it means, and can the Fed manufacture a soft landing? And the answer is we're going to have a bear, It's going to be probably worse than average. It could be a lot worse than average. And I'm going to talk about some of the things that could make it a lot worse in the next couple of slides. Really, the trade war issue is we're seeing front and center right here with what's going on with the arrest of the CFO of Huawei here in Canada to be extradited to the US. Everything to the border wall that Trump is talking about on TV today with Pelosi and Schumer that he wants to get paid for. It's the theft of intellectual property is massive. I mean, China can easily come along, and this is where I think the best case scenario is. They buy a few more products from the US, they lower some tariffs, they agree to steal less in the future without admitting guilt. And that's kind of where the deal ends up. Will tariffs go up another notch to 25%? Most corporations that have talked about tariffs in their earnings, this quarter's earnings calls, has said that 10%, we don't like it, it's cost pressures, but it's manageable. If we go to 25%, it's a game changer. So nobody wants that to happen. The Chinese don't want it to happen. The Americans don't want it to happen. Trump seems to not care, but he would rather have a deal than not have a deal. So we expect, and some of the analysts that we follow that really track this stuff, give it about a 30% chance that we see higher tariffs in the second quarter. So the next few months will be about negotiating this. It'll be about problems in France right now, Italian budgets, Brexit, shutting down the government because they can't get a spending bill passed. And there's going to be a lot more volatility coming in markets. And for me, volatility is a good thing. I like when the markets go up and down because that gives markets get mispriced and asset classes get, as they say, thrown out with the bathwater. And I love ETFs because for asset allocation purposes, bottom line, are very, very efficient. You can try to pick what stock you think is going to be the winner. It's way, way too difficult. The portfolio managers who pick stocks for a living, 85% of them in the long run don't beat the market after fees. So to think that you can pick a basket of stocks that are going to do better than an index fund is somewhat naive, because the long-term facts of the investment professionals just don't bear that out. Trying to be in the market and out of the market and time it from a day-to-day and week-to-week perspective, way, way too difficult. So again, it's all about asset allocation and portfolio construction, and I'm going to spend a lot of time on that. So trade wars are a big risk, certainly for the next couple of months, but I suspect we'll see some handshakes and agreements as opposed to something a lot worse at this point. In terms of rising interest rates and the probability of a recession, what I have on the table here on the left side of the graph is all the Fed rate hike cycles. And the truth is, not fake news, but the truth is that every single recession post-World War II has been caused by the Fed, as they say, taking the punch bowl away. All the pink highlights on the graph here are all the recessions, not including the ones in the 1950s. I don't have the database going back that far, but starting with the first ones in the 1960s, these are the recession periods, and the shape of the yield curve going into these. So basically, the current probability of the New York Fed's recession probability index of a recession within the next 12 months is 15%. So the odds today, the yield curve's not inverted yet. By the time the yield curve gets inverted, and I have some charts on these later on, that's when you're really going to see a lot of the damage already being done in markets. And so the history of equity markets say the average correction for U.S. equities is 13.4% in absence of a recession. And given that the probability of a recession is still well off into 2020 at this point, again, David Rosenberg argues we're already in it. There's no evidence to the fact, and the Fed just isn't going to start cutting interest rates for now to defend a recession with the unemployment rate as low as it is. So at some point late next year or in 2020, we do expect the Fed to start cutting interest again and probably more quantitative easing. But for right now, this dip should hold. But if it doesn't hold in the 25, 32, 33 range, which was the low from February, intraday low, the bear market would be confirmed in my mind, and my downside targets are in the 16 to 1800 range, which again I'll elaborate a bit more on this in this Monday show coming up. But make no mistake, it's the Fed raising interest rates that is the most important factor compared to trade, compared to credit risks in Europe and other market risk, geopolitical included. This is an updated chart of credit spreads in Italy. The current Italian 10-year bond is trading at 2.74%, which is lower than the 10-year Treasury at 2.84%. And my question is, who in their right mind is going to buy an Italian 10-year bond at that yield? And the answer is a speculator or a bank in Italy that really has to buy it. So at some point, we're going to see a big problem again in European debt, specifically in Italy, but it'll filter into Portugal and Spain as well. And we'll have a credit problem in the world. Again, this problem is probably late next year into 2020 before it fully manifests. As you can see, the stress that was put on by the Greek crisis in 2011 and 2012 and what that did to credit spreads. Back then, the ECB started buying all the bonds and all the spreads came in together. At the end of this month, the ECB is no longer buying through quantitative easing. They will do some long-term repo operations to keep spreads tighter, but ultimately, and bank lending liquid, but ultimately credit spreads are going to be under stress as we go through next year. So there's really all the good news of markets is in the rearview mirror in my mind. And at this point, we can only look forward to things that can be disruptive. The tax cuts are in the books, reforms are in the books. Everything positive that Trump was going to do is behind us. A wall isn't positive. These trade wars ultimately could be helpful, but are going to be very disruptive for supply chains and so forth. And I do think the Democrats, judging by the recent witnessing of Trump, Pelosi, and Schumer live on TV here in the Oval Office not 30 minutes ago, tells me or suggests that the Democrats are really going to throw Trump under the bus. Nobody likes this guy. They will find something related to Russia that is impeachable, and I suspect we'll see an impeachment. Now, I doubt the Senate will get enough votes to convict him, but I do think the risk of an impeachment is actually very high in 2019, probably the second half of the year. So as all these things are in front of us, it's very hard in my mind to increase the multiple on the market, to see earnings continue to grow with central banks kind of pulling back on the interest rate liquidity lever. And so the market top process is already underway. So we are now in the longest bull run in history, measured in number of days. Okay, so in terms of number of days from the lows in 2009, we have not had a recession. The markets have not had a bear market. It's longer than the 1990 rally that peaked in 2000 and measured in terms of number of days. But in percentage terms, it's the second biggest percentage change. Again, using the S&P 500 as the benchmark. I look at the S&P 500 primarily because it represents about 37% of the world capital markets, and by itself, it's the single biggest benchmark, with the U.S. 52% of the world equity markets. So Canada being about 3% of the world equity markets, I don't consider that meaningful in terms of positioning. Obviously, for Canadians, it's a bit more important, specifically those with interest in the banks and the energy stocks here in Canada. But generally speaking, it's a very, very poor index, and doesn't have enough technology, doesn't have enough healthcare in terms of some of the growth areas in the years to come. And most Canadians are terribly overweight the Canadian market, probably to the tune of 30 or 40 or 50% of their portfolios, and thereby missing out on some of the best potential growth in the world. That really, as bad as the US market is, it's still the best dirty shirt in the laundry, I like to say. Now, looking at the quality of this bull market compared to the one in the 90s. Now, the one in the 90s, we started with very, very high interest rates in the 80s, coming off the double-digit interest rates in the 70s and very high inflation. So you had a decade of falling interest rates, falling because inflationary pressures were easing, not falling because they were worried about liquidity in the world. At the second, you had the birth of the internet and the technology boom. And the quality of that bull market that ultimately ended in a bubble, you'll all remember, was fantastic in terms of the positive fundamentals. I mean, it ended in speculative bubbles about .com, but ultimately was very, very high quality. This current rally has been a decade of basically zero or negative interest rates and a doubling of the global debt in the world. Being it on a government, a personal, and a corporate basis. The average credit rating on the S&P 500 stocks are triple B minus, which is one notch above junk status, and that's a big credit problem at some point. And so it's something we need to be concerned about. So when I say how bad can the next recession be, I'm really thinking about these past recessions and how overvalued the markets are today. And so in this graphic here, what I did was I took all the recessions that we highlighted in the last graphic, showed from peak to start what the declines were in terms of equity markets. And on average, we're looking at about a 29% correction for equities. So what I'm showing in the graphic here is I've lined up all the past 5 recessions. I could have gone back and done all 10, identical graphic, by the way. So lining up all the recessions at ground zero, i.e. the day the recession was official. And the group that identifies when a recession is official is called the National Bureau of Economic Research. They need about 8 or 9 months of economic numbers to identify 2 quarters of negative growth. And basically, that blue line that you see there is the average performance of equity markets 1 year after the recession starts and 2 years prior to the recession. So while it is true the markets can rally still for a while once the yield curve inverts, basically, the equity market will peak on average about 8 months before. As you can see in the downturn and the more severe one in 73 to 75 bear, the equity markets peaked about a year ahead of the recession officially starting. So by the time Wall Street senses it coming to the time Main Street feels it coming, could be up to a year and a half. In the yield curve first inverted in June of 2006, and on the last recession, culminating in the 08 and 09 debacle, it actually started in December of 07, a year and a half ahead of the actual official start date of the recession. But equity markets actually peaked in October, so only a few months before. So there's no perfect guideline here, but this is a pretty good one. And once that yield curve inverts, and remember, we're not inverted yet, within a year of that, we can expect a peak in the equity markets. We may have already seen it technically. I doubt we're going to make a new high, but I could paint you a scenario that if we get a really good trade deal with China and we get another couple quarters of pretty decent earnings without all these trade issues and tariffs getting into the bottom line of corporations, i.e. they're able to massage the books for another couple quarters before they have to do a mea culpa. that the markets can see possibly one more new high in 2019. I could paint you that scenario. In any case, that's the time to batten down the hatches. You should not be buying new highs here. You should be selling and getting very defensive. And I'm going to show you some of the things that we can do. First, I want to talk about some of the things I like, long term, and some of the things I'm really much more positive about in terms of long-term themes. Now, having said that, and I like all these long-term strategies, I do think they're extremely volatile and higher risk at the moment. One of the biggest ones and my favorite ones is artificial intelligence and robotics. I believe within a decade, pretty much all the portfolios in the world are going to be run by computers. Computers are assist portfolio managers today. Sometime in the future, you're going to need one person to make a decision and have a dozen computers running portfolios. Ultimately, you'll need a trader to execute. And you could argue that the computer can actually do the execution, but I would argue that you don't ever want that purely because that's where those flash crashes can really exacerbate things where the human has a better opportunity to have a qualitative assessment of market volatility. In any case, with the market new lows that we've seen here, again, we're seeing new lows on most of these ETFs, and it's just a high risk, high potential return sector. But I would wait on these until they're much lower, certainly lower than current levels. But in terms of valuations, probably not a core buy and hold and forget about until after the next recession plays out. Now, when you're doing your homework on these, I've always get the question, Larry, which one should I buy? Well, look, the answer is I don't want to go tell you which one to buy. What I would like to show you to do is how to go about selecting which one to buy. So liquidity is a factor. And so in the upper left corner, you can look at, well, what are the MERs? What's going to cost me? How many assets are in these ETFs? When did they start? How long have they been around? But more importantly, what is my risk? What am I holding? And so you can look at some of them and you can see that in some cases, you've got very different exposure than in others. There's obviously a lot of overlap in many of them, but they're all different weightings. And when you look at the bottom tables, it shows you by way of currency exposure where your risks are. So if you buy one of these as a Canadian, obviously you're more exposed to the US market. You're more exposed to the Japanese yen in particular. Those are the two real big areas. So if you bought the BOTS ETF, it's 30% US, 47% Japan exposure. If you buy the IRBO, 58% US and only 11% Japan. So, those things are factors you need to consider. When we look at the performance of all of them, the big difference often is the holdings. Are they equally weighted? Are they market cap weighted? And what the currency exposures are. Those are going to be the differentiating factors primarily between all of these kind of holdings. You can see Apple is in the IRBO. What is Apple doing that's an AI? Maybe a micro fraction of Siri, for example, qualifies as AI. So in their version of what robotics and artificial intelligence, Apple makes the cut where it doesn't in all the others. So do your homework, go to the website provider, find out what you're owning before you take the position. Very important consideration. Biotech and marijuana sector, in other words, healthcare, for me, it's not about smoking weed. It's the medical side of things that I think is going to be pretty huge. Having said that, at the recent highs in HMMJ, I put out a short recommendation literally the day that Tilray hit $300. I put out the short when Tilray hit 260 or 265, and then I think 10 minutes later it was at 300, and I was just retweeting and saying this is a classic blow-off bubble, and these things are short for at least back to the base, which is where we tested in the $15 area in the last couple of days here for HMMJ. But at the peaks, these stocks were trading at valuations where if the industry's wildly successful, might be worth 5 or 10 years from now. And it's no different than what we saw at the peak of the dot-com bubble, where it took 10 years, for the or more for the Nasdaq to recover. Actually, it was 13 or 14 years for the Nasdaq to recover back to the highs seen in 2000. After the double bubble bursting in the last 20 years or so, in markets. So biotech is going to extend our life, and healthcare, and this is a huge area where outside of the marijuana stocks, Canada has virtually no exposure. So you really have to think globally in your portfolio. BBC is an interesting ETF. That it's the Virtus Life Sciences Biotech Clinical Trials ETF. And what this does is look at a lot of the companies that have key drugs going through crucial phases of FDA approval. And if you've ever tried to trade these individual stocks, you know that if a key drug doesn't hit, the stock gets cut in half the next day. So massive area where you have potentially new blockbuster drugs coming, but you get diversification across all these things. And that's just a much better way to play the sector. Again, very high risk, potentially very high return, but I wouldn't touch it at this point. I think valuations are still overly too high, and you got to wait for much more of a market correction. But longer term, at some point, it's a buy and hold for years. Clean energy, what I like to call, or what the industry calls ESG, which is environmental, social, and governance. Basically, you're looking at areas that are being good corporate citizens. And so in the clean energy space, I think it's going to be a huge growth area for years and years to come. But like other relatively young industries, tremendous volatility in some of these things, specifically around some of the solar. You can see the orange one there, the TAN ETF, which at the lows in October was down 30% year to date. It's now down 20% year to date. A week ago, it was only down 13% year to date. So tremendous volatility in these types of holdings, especially in the solar space, as the U.S. had clamped down on with tariffs on Chinese solar companies. But this, if you really believe in the clean energy and the low carbon future, you do want to pay attention to ESG investing, because this is where ETFs are popping up that have good environmental footprints, good social footprints, meaning no child labor, for example, and good corporate governance, meaning fairness of pay equity, representation of women in the management suite, etc. So you can do some work on that area as well. But here's in terms of clean energy, I think it's going to be a high growth area for years to come. Water infrastructure, there, I think this is a bigger picture here, but here's a sector where I think if we get another pullback like we saw in 2015, 2016, is a buy and hold for a number of years. We don't have enough clean water, water desalination, the whole infrastructure in terms of sewers and pipes in North America and in Europe is hundreds of years old, needs to be all redone. Water purification, everything related to water safety. Bottom line, we don't have clean water, we don't have people. And this is going to be a massive investment area for governments globally for years and years to come. Very expensive right now. And it, again, potential long-term high returns, but significantly high risk as well in this area. And finally, cybersecurity. Well, not finally, I got one more after this, but I get asked a lot about cryptocurrencies, and I've been on record for years now saying they're all worth nothing. Fundamentally, they're not going to replace gold. It's not going to be an independent digital currency world. Anybody who believes that is a con man or naive. I do believe that we will, one of the long-term solutions for government debt is to fix the tax system. And what's required there is getting rid of the gray economy. If every single transaction is digital, and taxed at source. You clean up the gray economy. There's no dual registers. There's no cash business. You could still barter for sure, but you're just not going to go exchanging chickens for dental services anytime soon. So ultimately, every transaction is going to be taxed at source. Government gets their money right away. Merchant gets their money. You get rid of a whole layer of a burdensome tax filing and et cetera, and it really cleans up the system. I like to use the example of a cocaine dealer selling you the drugs. So today you got to pay cash for that. Obviously, you're not buying it on credit, or you might pay Bitcoin for that. And that's the argument, perhaps only argument, for why Bitcoin can continue, but ultimately I think gets legislated away. So ultimately, governments will always control the money supply. The money will be digital at some point because it has to be. Therefore, keeping the electricity grid going, redundancies and batteries, backups, and all those things are going to be essential. And cybersecurity, by far, is going to be one of the biggest growth areas for decades to come. There's 3 great ETFs there. Any one of them is fine to own. Again, you got to think about the currency exposure when you do own them. It's a little expensive right now. It can be very volatile, as you've seen. These things have corrected good 20-25%, where the S&P is only corrected around 10, year to date. So higher risk. But longer term, I really like the sector. I have got no exposure right now, but I've got it earmarked for buying at some point next year, or maybe in 2020, to take a really material position here. And then finally, e-commerce and the internet disruption. Bottom line, anything that makes things cheaper, faster, you name it. There's some great individual ETFs to play the Internet of Things, Chinese internet and e-commerce, broad emerging markets. Israel has some of the best cyber technology companies in the world. ITEQ is very interesting, and so forth. So lots of interesting ways to play e-commerce and the internet. Again, look at the chart, understand the volatility. You're going to have to assume if you want to buy these things. And again, great long term, but I think for the next year or two, as we go through this bear, you got to be careful on how you buy these things. Okay, so getting into the investment side of things, Dan already covered what ETFs are all about. So I'm not going to spend too much time on that, but basically a low-cost mutual fund that trades on the stock exchange. I want to get into the understanding of what options are. Most people are familiar with what a covered call option is. In other words, you own the stock and you write a call to generate more premium. But basically, you own a stock at 50. The analyst 1 year out says price target is 55, and you can go out 1 year and write an option at 55 to sell it at that price, and probably increase your yield by 2 or 3%. While you're just waiting to sell it at what the price target is anyways. If it doesn't go above 55, you earn the premium and you get to keep all of it. So if the market goes flat to down, sideways to down, you're better off in a covered call option. If the market goes up and a year from now it's at 60, well, then you must sell it at 55 if you've written that call, and your net position is the 55 that you get plus the premium. So maybe that's a $2 premium that you would earn, so net you're selling it at 57. But if a year from now it's at 48, you've taken that extra $2 that you wouldn't have had writing that option. So in a sideways to flat to down market, covered call strategies tend to do best. But when you're at a low point and the market's going up, covered call strategies are going to underperform. Now, the other side of options, people are used to buying puts to protect their portfolio. So let's say you own Apple and you've owned it for a long time. You don't want to see it break support at 160, and so you buy a put at 160 for a couple of months. Now, if you bought that put today for, say, the next 3 months, you're probably paying a 5 or 6% premium at 160 to buy that put. Now, on the other side of that person is the person who sells you that put. So I may not want to buy Apple right here, but I'm okay buying it, let's say at 150. So I would say I'm going to write a 160 put, and I'm going to look for an option that pays me $10 in premium. And right now that option would be out to the end of next year. So I can get paid a $10 premium for waiting to buy it at 160. And if it doesn't go below 160 at expiry, I don't own it, but I get to keep my $10. So I'm basically making on $160, $10, which is about a 6% yield over the next year. And if it gets to the price I want to buy it, great, I have to buy it at that price. And so when you're writing puts to generate yield and potentially buy things cheaper, you must want to buy the underlying position. Okay, that is very, very critical. And because you must want to have to buy them, you don't have the option. It's an obligation when you write the security. When you buy the security, you have the right to buy it, but not the obligation. When you're selling the option to someone, you don't have the right anymore. It's an obligation. Okay. So a couple other points here I want to talk about, meaning risk in terms of volatility. So the standard definition of volatility in markets is the standard deviation of returns. And that basically you can think of the value of your portfolio that goes up and down, up and down, up and down every day. That's the standard deviation. And finally, what drives that option premium that you get is called the implied volatility or the ride. So the more risk there is in portfolios, the more standard deviation there is. In other words, what the VIX measures, and we all know is the fear index, what the VIX measures is the implied volatility of all the S&P 500 companies 1 month from today for their calls and puts. So what are the option makers charging for volatility? And that's basically a measure of standard deviation. So all those things are pretty important in terms of using options and understanding when to use them in portfolios. So there's 4 types of positions you can take. The riskiest position is just being long the market. Okay, you could lose 100% of your investment in a single stock. Now, in a basket like an ETF, you're almost never going to lose 100%. I would argue that some of the leveraged ones you could potentially lose 100% or close to it, but ultimately on a basket of stocks, some might go down more than others, but ultimately you've got diversification. So you get rid of what's called single stock risk or idiosyncratic risk. So buying a single ETF or stock is the riskiest position you can take. It also gives you the most upside, meaning you get all the upside if you're right and it goes up. So I'm showing 4 ETFs here. I'm showing the Vanguard versions of the total US market, and as of yesterday's close was down. The world market ex-US was down 13% year to date. The TSX down 6.5%. These include dividends, and emerging markets down almost 16% year to date as of yesterday's close. So where you invest is critical. I've been saying for years now, you got to be overweight the US, and what that means is more than 52% of your portfolio should come from the US market if you want a chance at beating the world. If we looked at 5-year returns, which I don't have here, but if we looked at 5-year returns, TSX is barely up in that time frame, emerging markets is not up, and Europe is barely up. The only market in the world over the last 5 years that's up materially is the US market. And again, I'll reiterate the point, where you invest and your asset allocation is crucial into your ultimate success. Most people tend to be way, way overweight Canada. So a defensive position is looking for high dividends with a covered call overlay. And BMO's got a bunch in this suite that I really like, but for international exposure and Canadian exposure, ZWS gives you a currency hedged high dividend US covered call exposure with a yield just north of 5%. The European ZWC is, again, Europe high dividend covered call. It's down 9% this year. And the Canadian high dividend covered call is down 7.4% this year. So Covered call dividends aren't doing particularly well this year, although they're still my favorite place to be in more defensive portfolio environment. Why are these not up so much? Is because when you look at the average stock in the US, again, the average stock, it's down about 9% year to date. Now, the US indexes aren't because they're market cap weighted, and there's still a handful of technology stocks that, even though they're well off their highs, are still up significantly this year, changing the color really of the US market. So these things are important to understand when you're doing asset allocation, what's driving the returns. And so the average stock right now is still globally, about 75% of stocks are below their 200-day average on a global basis. And you saw the stats in Europe and emerging markets being down significantly, Canada being down significantly again. A handful of stocks in the US market are painting the picture that the US is actually doing well this year, and really on average it is not. So covered call strategy is defensive, but really what I want to talk about and focus on is how and when to buy. And this graphic was updated a couple weeks ago, but basically at that time the S&P 500 Spider ETF was trading at 263.25, and it had a yield, a dividend yield of just over 2%. So if I wanted to write a covered call, for example, out to the next strike price, which would be December 21st, that call I could get 8 cents for. So really, it's 10% above the market, 2 weeks. There's very low probability, so there's not much premium in that. Going out a year from now, if I wanted to write a covered call out to the end of December next year, I could generate, so I could buy the SPY today for 263.25, get a dividend yield of 2, potential to make 10%, and an additional 3% yield by writing that covered call. So if the market falls 3% over the next year, I'm neutral, right? So that's one idea, like what a covered call could do. Now, if you don't like the market level at 263 and think I'm right, and maybe it's going to fall another 10 or 15%, then what you could do is say, okay, 14.5% lower. At the end of next year, you can write a 225 put your money in cash, and get a yield of 2.89% plus the cash yield. So money market in the US right now yields 2%. So you could buy SHV, which is a money market ETF, get a yield of 2%, write the put for the S&P 500, get $7.62 for it. And if we get down to 22.50 on the S&P, 225 on the Spider, you have to buy the market at that point. But now you've increased your yield to money market plus 2.8, so 4.89% yield sitting in cash while you're waiting to buy the market 15% lower. Now, if you think that my really bad scenario plays out and we can get to 16 to 1800, you can write the put out to the end now of 2020 at 180. That's 1800 on the S&P 500, and take in an additional yield of 1.8%. So learning how to write puts to buy things that you want are actually quite attractive as a strategy. So what I'm showing you here is 4 different portfolios that I put together on August 30th. A single long on the S&P 500, and at the time the S&P 500 was trading at 290. Okay, and that's why I had 290 in the graphics before. So a single long at 290, you can see the blue line. At the bottom, recent bottom here, we were down about 9%. Okay, so that's 290 less where we are, 260, whatever the close was yesterday, around 263 or 4, something like that. Now, you could have, on August 30th, bought the SPY and wrote an at-the-money covered call, meaning the 290 call. So you had no price gain potential, but that 290 call yielded you about 3%. So you can see the red line by being long with the covered call is only down about 6, okay? Because you've earned the yield of the covered call, because now the call's that far out of the money. It's trading at 8 cents right now, as we saw in the last graphic. Another way of doing a synthetic covered call is what's called a put right at the money. So you put your money in SHV, you earn a money market yield in the US right now around 2%, and you write a put at 290. So if by expiry at the end of this month, the 21st, a week Friday, you're below 290, you have to buy that ETF at 290, but you got paid a premium for that, and that's the green line. And as you could see, the premium on that plus what you earned in the money market is very similar to the covered call strategy. So that's called a synthetic covered call, so a put right strategy. Now, the most defensive thing you could do back when the S&P was at 290, say, okay, if it pulls back some amount, 5%, 10%, whatever, you have to figure out what that is. So what I did was I picked 5%. I said, if it dips to 276, 5% below where it was, I'm going to put my money in a money market ETF, SHV, and I'm going to earn the premium from writing the 276 put. And look at what happened. Look at that black line. You had a lot less downside, and even still is only down 3% year to date, while the markets are down a lot more. So ultimately, if that option expired today, you'd be long the S&P, you'd sell your SHV because you got to pay to buy your SPY, and the option expires, and now you're only down 3%, but the market's 9% lower than where it was. So that out of the money put right strategy, waiting to buy it cheaper, gives you extra yield and gives you a lot of downside protection. As you can see, it doesn't eliminate the downside, but it gives you a lot of downside protection. So one of the other things I like to do, if options aren't for you, is to use ETFs that have option strategies and low volatility strategies embedded in them. And so what I'm doing in this example over the last year is showing you an equal weight exposure to the ZPW. So that's the put right strategy, which takes some great US companies and writes puts on them 15 or 20% below the market and generates a yield of about 5%. ZWH, which is the high dividend covered call strategy. Again, great dividend paying US stocks with the covered call, and ZLU, low volatility US equities. When I take all those 3 ETFs, equal weight them a third, a third, a third in a portfolio over the last year, those yield me about 5% yield. Okay, so very nice yield in the portfolio. And I'm comparing this to the Vanguard Total Stock Market ETF. So all the stocks in the US, basically, VTI. And you can see in VTI, which is the orange line, as markets are strong, you know, the pure exposure to markets, you get more upside. When the markets are weak, the corrections in the white line are actually much less. Now, end to end, over the last year, these 2 ETFs are basically identical. So ZPW, ZWH, ZLU combined has about half the volatility, half the risk of the US equity market, but it has 2.5 times the yield. So in a scenario where we go into a bear market and the US equity market falls 20%, let's say, so I would expect ZPW, ZWH, ZLU combination to fall about half. So it's got about half the risk. It might be 60%, it might be 40%. It's hard to say. It's going to depend on how fast it goes down and a couple other factors on volatility, which you can't know in advance. But the expectation is that it'll fall half. And while it falls half, you get about a 5% yield. So net over a year, you're down 5% in a 20% bear market. That's pretty darn good. And so when I'm defensive, I want to hold more of those ETFs in my portfolio. And then once it falls to the levels that I like the market, I get out of the defensive ones and I flip back and I buy my VTI or my S&P 500 and I get all the upside as the markets recover. So those are some of the strategies that I use in the sleep at night portfolios, whether we're using option strategies or we're using, you know, just shifting the exposure around with different ETFs. So when do you write the calls and when do you write the puts? I do something very simple. I look at a trend channel. So this is a statistical technique using a linear regression over the past year. And when we're at the top of the bands, I simply, those are the times you want to be more defensive. And when you're at the bottom of the bands, you generally want to be more aggressive. It's pretty simple. It doesn't take a lot of work to it. For most free online software packages have something as simple like this, and you can use the RSI indicator or some other tactical tool to help you figure out when the markets are overbought or oversold, and you can adjust your positions accordingly. So you got to think like a market maker. You got to think like a strategist when you're doing your portfolio. And what I like to make the analogy is using casino analogy. Not that you're gambling, but you want to make bets when they make sense. So in a casino analogy, playing the game blackjack, when the dealer has a 6, the probability of the player advantage is the highest. The odds of the dealer going bust is 42.08%, and the player advantage is 23.9. So when the dealer has a 6 or a 5 for that matter, that's when you want to make your maximum bet. That where if you have a pair of 8s, you split your cards and you double your bet, because the probability is the dealer goes bust and you win both hands. If the dealer has a 9, 10, jack, queen, or king, the probability is less than 25% that they go bust. And the player disadvantage is pretty extreme. In fact, you have a significant negative disadvantage when the dealer's showing a high card like that. And that's just the way the probability is. So in investing, you want to make a bigger bet when the odds are favorable. So one of the things you can look at is seasonality. And so in this graphic here, I'm looking at the seasonality of US midterm election years. And while October was weak, November was a positive. December is expected to be a positive. So far, not so much. But it does suggest, from a risk perspective, that buying dips this time of year is actually a reasonable probability. So again, do you want to buy this dip here? Is the market going to break down now? It might, but the probability is that we should be okay for now. When's the next big risk factor in terms of markets breaking down? Well, it looks like January, could be potential risk, and then as we move into next summer, there's also obviously some potential risks going forward from just looking at seasonality. In terms of what outperforms, this is a very interesting graphic. I look at style. So which kind of, in different economic scenarios play out. So in terms of a market expansion, value and momentum are the two styles of investing that give you the best upside in terms of risk adjusted return, so Sharpe ratio. When markets are in slowdown periods or contraction, you want high quality companies. So BMO's got a suite of quality ETFs, and you want min vol. You also want option-based strategies. So those tend to outperform in a down market from a risk adjusted perspective. And once the bottom comes in and you get into the recovery phase, you want to go to the value stocks. So as you go through the ups and downs, there are different styles of investing that suit each environment. So the final piece here in the last 5 or 10 minutes, and then we'll go to some questions that have come in online. Ray Dalio, I'm a huge fan of. Ray runs the biggest hedge fund in the world called Bridgewater. I encourage you to go to Ray Dalio's website, buy every book that he's ever written. He's got a free one now out on debt cycles, exceptional reading. Read his what he writes about all-weather portfolios, about risk parity, about the economic cycle, and understand in what environment, when we have accelerating growth or slowing growth, rising inflation or slowing inflation, which asset classes do the best. And this will give you some hints into what you put in your portfolios. A couple of people have asked about gold and what my forecast on gold is. Well, gold tends to perform the best during rising inflation, slowing inflation, and slowing growth. So we have a slowing growth environment, so it tends to perform very well. It doesn't perform well in accelerating growth and slowing inflation. That gold is not in that quadrant. So that's basically been the last couple of years of accelerating growth and slowing inflation. Now we've got rising inflation, so gold makes a lot of sense. And we've got slowing growth where gold makes a lot of sense. There's definitely some risk to gold. I don't think it's going to break out in a material way, but it is one of my biggest positions right now in the portfolios. When it comes to portfolio construction, you have to understand about risk and return. So if I'm going to add something to my portfolio today, am I going to increase the potential return at the same level of risk, or am I going to take more risk for the same return? Right? That's the simple question. And when I'm building a portfolio, and what I'm going to show you how to do here is to try to get the highest return possible with the least amount of risk. That's what I do in my sleep at night portfolios. I've talked about it for over 6 years now on BNN, and as Dan talked about, there are 3 funds currently. One of them, the Global Tactical Dividend Fund, will be out in the new year in an ETF format. Ticker symbol will be ZZZD, Sleep at Night Dividends. I'm going to do a whole feature show. I think it's the second Monday in January. We have that targeted to launch around that time. So it's already been approved by the regulators. Okay, so in building the all-weather portfolio, the key thing to understand is how all the different asset classes work in a portfolio context. In the graphic there that Dalio put together, I've covered a lot of these ETFs that represent those various types of asset classes. There are others. Okay, this is not intended to be a portfolio solution. It's intended to get you going in the right direction. So, and this is not an entirely recommended list. Don't go out and buy all these. Again, you got to know how to use them. So when you're putting a portfolio together, again, to generate the highest return possible with the least amount of risk, you have to understand about diversifying. So correlation is a very important thing. A correlation of 1. So when you look at EEM, Emerging Market ETF, and SPY, the correlation in this graphic in the upper left side is 0.07, 70% correlated. So basically, you're not getting a lot of diversification benefit. A correlation of 1 means they do the same thing. A correlation of -1 means they do exactly the opposite, and you get no benefit by having 2 of those things in your portfolio because they offset each other. When the correlation is near 0, that is your maximum diversification. So for example, GLD, Gold Bullion ETF, and SPY, over the last 2 years on a weekly basis has a correlation of 0. Gold and SPY in the same portfolio give you lots of diversification benefits. Emerging Markets, EEM, and TLT, US long bonds, has a 0 correlation over the last 2 years. Now these correlations change. You can actually put the prices of these ETFs into a spreadsheet and side by day and do a correlation calculation. And you can calculate on your own in spreadsheets. So you have to have abilities to track data in a spreadsheet. And I hope if you guys are doing portfolios on yourselves, by yourselves, you're actually doing some of that work. Floating rate notes compared to emerging markets, no correlation. Having exposure to the euro in your portfolio compared to high yield bonds, HYG, has almost no correlation. US oil compared to the euro, no correlation. Global mining stocks compared to US utilities, almost no correlation, and so forth. So by taking all these different asset classes and putting them into a portfolio together on an equal weight basis, you can do something like this. So what I've done here is I've compared the correlation of each ETF to the world index using the Vanguard Total World Index, VT. And that one ETF covers all the stocks in the world. So SPY, S&P 500 has a yield of 2%, correlation to the world index, 95%. Emerging market, US, correlation, 80%. US utilities, 25%. US bank stocks, 58%. REITs in the US, 46%. Inflation index bonds, 7%. High yield bonds, 69%. Long-term treasuries, 1.7. Floating rate notes, 13.5. Global mining stocks, 62%. Global gold stocks, 17%. The yen, which is a flight to safety currency, negative 15%. US preferreds, 45%. When you take the equal weight correlation and the yield of that portfolio, you now have the yield that's equal to the Vanguard Total World Index, 2.66%, but you have a risk that's 40% of the index. So now I've put together a portfolio of different asset classes that has the same expected yield, but I've got significantly less risk or volatility in the portfolio. And that's the essence of portfolio construction. ETFs are just so great for this, and why I really love them. I want to talk a little bit about currency hedging, because when you're investing globally, it's very important. You can use ETFs that hedge and not hedge. What this graphic shows is that since the world started using floating currencies, i.e. we came off the gold standard in 1971, from 1972 on, the absolute value of the change in currency, Canada US, Canada Euro, Canada Yen, and Canada British Pound. Canada US, 5.39% per year either helps you or hurts you, with the median being about 4%. When investing internationally, the currency impact is as much as 10% per year, either helping you or hurting you. And very simply, I run a very simple thing. Here's the trend channel. When we're at the top of the trend channel, I want to be in a hedged ETF, and we're at the bottom, I want to be exposed to the currency so it can help me in terms of my returns. In terms of the Canadian US dollar, we have to look at interest rate spreads, because that's a factor driving money between Canada and the US, and our biggest commodity, which is crude oil. That's another factor driving money between Canada and the US. And finally, the speculators in the futures market. Those are the key variables that I look for in terms of when to hedge the US exposure in my portfolios. And then finally, just a snapshot of what the current 130-30 balance portfolio looks like. When I say 130-30, I'm using a little bit of leverage, meaning I'm long up to 130% of things I like, and I'm short up to 30% of things that I don't. So still 100% exposure, but long more things that I like and short things that I don't like. So you can see right now, I'm long emerging markets with a covered call that expires a week Friday at 42. I'm long gold, 20% in the portfolio with a covered call, again, expires a week Friday at 120. I'm long US banks with a covered call at 58. I will buy the NASDAQ if we fall another 10% from where we are right now. And last month, I took in 0.75% to write that put for the month. And if it gets there, I'm happy owning the NASDAQ at that point. I'm long treasury bonds with a covered call at 116. So that's going to be called away this month. But I'm also wrote a put to get even longer US treasuries at 112, and that's going to expire useless. So I take all the premium for that. As oil prices collapsed last month, I wrote a put to buy US oil at about $45. That's going to expire worthless, so I took all that premium. And I would bought some US REITs at 75 if the ETF was there. It's currently trading at around 80, so that will be accrued to me. And I've started to leg into some preferreds because they've sold off so much. And there's a very nice yield there. And I've got a BMO ETF with high dividend covered call exposure to Europe as some of my core international equities that I like. That yield is north of 6% on that one. So ultimately, over the last year and a half in this portfolio, you can see what a traditional 60-40 balanced portfolio did in terms of the benchmark. And that's what we did in our portfolio, generating a higher return with less risk. So that's kind of the idea of the sleep at night portfolio. You can today, in terms of all those long-term niche sectors that I talked about, on average buy them 6% cheaper today by writing these puts and taking in these premiums, generating a yield of 1%, while on average buying them about 6% lower. So again, you can look at some of these areas. for things that you'd want to buy, HMMJ at 15, for example, and 2 weeks ago I could have got 25 cents for that, taking in 1.67%. Based on where it was at the time, almost 17% below the current price of HMMJ. So again, hopefully those are some ideas for you. And now I will look for some of the questions. And what's good in a TFSA? What about registered accounts? What I didn't mention is a lot of these option writing strategies, because you must buy the position if it gets put to you, cannot be done in a registered account, because if you have to add more money, you can't if you're maxed out. So it can only be done in margin accounts or taxable accounts. In terms of the ETFs that I manage, the one that's coming out, ZZZD, that's eligible for all kinds of registered portfolios. Any of the ETFs, the core ETFs that I've talked about, they're all eligible for registered portfolios as well, all the ETFs that I've talked about. Dan mentioned some tax implications in Canada, Canadian accounts versus US. So if that's something sensitive to you, you might want to not own some of the US ones, but buy some of the Canadian ones that have a little bit more favorable tax treatment as well. Instead of trading options, can I use an ETF to do just about the same strategy? So that's where I went back a few pages ago, and I'll page back a little bit here to this strategy here, where I talked about the two different portfolios between using ZPW, ZWH, and ZLU versus the total long position in the US market. So when you want to be defensive in the US, these three ETFs make a very low risk holding. Again, it's not risk-free, folks, but you're generating a yield of around 5%, and you're doing it with about half the risk of the broad US market. And when you want to be long the market and we want all the upside potential, then you don't want to own those three, and you want to own VTI or any of the S&P 500 ETFs that give you, all the upside as the markets are doing well. So that's a very, very simple strategy where you don't have to get involved in option writing. But I encourage everybody, because I think the next couple years are going to be very, very challenging, to challenge yourself to learn about option writing, enhancing the yield in your portfolio as opposed to just putting your head in the sand and worrying about markets and not having enough yield to live off of, etc. Okay. Okay, what else here? Any other questions? Tax implications for ZZZD. So we do a lot of trading. There's a lot of turnover. When we play defense, sometimes I'm going to hold some bonds in there, so there's a little bit of income that comes off the portfolio when we're playing defense. So it's kind of like a balanced dividend fund, if you will. So to turn the risk down, I'll use these three ETFs. I'll use other covered call strategies. I'll use uncorrelated assets like gold and gold equities to take the risk down in the portfolios. So there's a lot of dividend exposure. Now, because it's a global, when a dividend comes off a global ETF, you don't get the benefit of the dividend tax credit. So on average, about 20 or 25% will be Canadian dividend exposure. So there would be some tax benefit on the distribution there. In a registered account, none of that matters because it's all income once you withdraw it from your registered plan. In a taxable situation, all the trading that goes on is not the most tax friendly, although a lot of capital gains, so that is tax friendly. But every year you're going to have a distribution in the fund. We do our best to minimize those distributions by doing some tax loss selling. I've invested about 50 of my RSP into ZLB the last 5 years. That gave me the best return versus the TSX. Any comments? So the low volatility strategy, which ZLB is for the TSX, has done very well. It probably should do well through the next downturn. A lot of those low volatility holdings are the Canadian banks. And so the caveat here is when we do go into a recession, I expect the banks and the TSX to fall on average about a third. If you go back and look at every other recession historically, Canadian banks fall somewhere between 20 to 35%. In the average of around 33. But we saw the Canadian banks both in 2000 to 03 and in 2007 to 09 fall 50%. Okay, so the low volatility banks will be embedded in ZLB, and so you can you'll have that risk at some point. How can I buy ETFs with little or no commission so I can average in slowly without paying large commissions over time? So that's a great question. I know in the US they have some low cost or zero commission strategies on Fidelity and Schwab. I don't think they have much of that in Canada. There may be some promotions on certain discount brokers. I think Questrade from time to time has no cost ETFs, but I think they're the Questrade ETFs only. They used to do some promotion years ago on no cost ETFs in terms of trading cost, the $9.95 in and out. So otherwise, yeah, I think the US is really the only place so far that has that, but you can try Questrade. How can we have access to the tactical fund monthly updates, particularly for those interested in the new ETF fund itself? I talk about them on the show. I do produce weekly updates. We will have a website actually, and the website is going to be announced with the launch on the show on January 14th. That website will have our weekly updates on the funds, a lot of commentary by me, etc., on what we're doing in the funds, etc. So you can go to that website, and the information on that will be out on the second Monday show in January. Okay, Questrade does have no fee buying ETFs, but you pay when you sell them. Okay, so thank you for that. What else do we have here? Got a few minutes left. How do I purchase your sleep at night mutual funds? As Dan mentioned off the top, if you're going to use the mutual fund version, ask the discount broker for the D class funds. So it's the BMO Global Tactical Dividend Fund, the BMO Global Tactical Balance Fund, the BMO Global Tactical Global Growth Fund. Those are the three funds, and you want the discount version, the D class version. What do I think of the current China-related tensions? I did talk about that off the top. I did say that the potential is about 30% for the trade war to really escalate with China. And we're probably going to see some kind of deal. It's not going to be everything Trump wants, but it'll be better, and he'll be able to pound his chest a little bit. So that's the most likely outcome at this point. There's going to be a lot of rhetoric back and forth that causes market volatility between now and the end of March. So you can bet that. And occasionally you're going to see a tweet that's quite positive, and the markets will respond for a few days, and then he'll come out with his style of being belligerent and say something bad, and the markets will sell off. And you're going to have a lot of up and down, and get choppy. And for me, again, that's opportunity, and I don't mind that. Is ZZZD only defensive or also aggressive in good times? So as markets sell off, what I do in the funds is get rid of the defensive ETFs and get more aggressive. So I control the beta. So the beta of 1 is the world index. So VT, the Vanguard Total World Index, that's a beta of 1. It's every stock in the world. If you're trying to beat the US market, a beta of 1 could be the S&P 500. If you're trying to beat the TSX, a beta of 1 could be the S&P TSX. So a beta of 1 is your target. When I'm in a risk-off mode, I want to generate the highest yield possible, typically more than 4%, but I want to do that with taking half the beta or less. So half the risk or less of the world index. So again, if we go into a 20% decline, I expect to go down, half, and I get a higher yield while I'm doing it. Once I get that decline and we like the value, we get out of the defensive ETFs, we get aggressive, we take the beta up towards 1, and we get all the upside as the markets recover. That's the idea of being tactical in the portfolio. I'm 69 holding your ETF, no problem after I hit 71. No, I think it's no problem for whatever age you're at, because so we've won 2 major awards for the fund. One's called the Fund Data A+ Award, and that's given to the fund with the best risk-adjusted returns. So when you compare what return you get per unit of risk that we take, i.e. the volatility of the portfolio, we were number 1 in class in 2017. In 2018, we won the Lipper Fund Reward for the best overall returns adjusted for risk over the last 3-year period. Okay, so it doesn't matter what age you are. I think it's appropriate for everyone because we do focus on managing risk. It's not risk-free. In a 50% bear market, if I'm doing a terrible job, it might be down 20%. If I'm doing a great job, it might be down 10 or 15. But it's going to be down in a bear market because I can't go short. Okay, but it's going to generate a 4% yield while we're doing it. And if you need to stay invested because you need the yield, then it's the fund for you. Once the market washes out, sometime in 2020 when the bear fully plays out, we want to be really bullish there. Anyways, it's 2:30, folks. It's past time here. Thank you so much for joining us today, and you'll get an email. We'd love your feedback on the presentation, and there'll be a link there to download the slides, and a reminder there, if you can step up for one of our charities, I'd be thrilled to match your donations. Thanks so much, and we'll see you on BNN Bloomberg.